Hey guys, this is Vyom Joshi with Superior North. Welcome back to my channel. Today we will be talking about a stock that was suggested by one of our subscribers. That stock happens to be Macy's. Macy's is an American department store that operates in 839 stores, as well as Bloomingdale outlet units and small specialty units in the United States, Guam, and Puerto Rico. Looking at the 2019 sales numbers, we can see that women apparel and accessories accounted for 61% of the sales, men and children accounted for about 23% of the sales, and home and miscellaneous items accounted for 16% of the sales. Lastly, Macy's has about 123,000 employees, and its private label and exclusive brands were about 20% of its total sales. Now that we have a higher level idea of Macy's, let's look at the fundamentals of this company. Today we will be talking about Macy's key ratios, performing a discounted free cash flow DCF analysis to find the intrinsic value of the company, and lastly, do an expected rate of return calculation to see if we were to invest in Macy's at the current stock price, what kind of return can we expect on this investment? So let's dive in and look at Macy's.
Hey guys, let's start off by looking at the key ratios. I'm on Morningstar, looking at Macy's under key ratios. For financials, the first item on the list is the revenue. The revenue is the top line of the company. This is the amount of money that the company makes from its sales. All the numbers here are in millions of dollars. We can see that back in 2011, Macy's revenue was about $25 billion, and that number grew to about $28 billion in 2015. And ever since then, there has been a decline in the Macy's top line number. In 2020, Macy's revenue was about $25.3 billion, and for the trailing 12 months, it's about $19.6 billion. Next, looking at the operating income. The operating income gives us an idea of how much money is generated from the company's core business after deducting for the operating expenses. All the numbers here are in millions of dollars as well. We can see that back in 2011, the operating income was about $1.8 billion. That number grew to about $2.8 billion in 2015, and ever since then we see a decline in the operating income. For 2020, Macy's operating income was about $1.1 billion, and for the trailing 12 months it was negative, primarily because of the shutdowns and the pandemic, which caused a decline in its sales. After that, looking at the operating margin. The operating margin is the ratio of the company's operating income to its revenue. So it compares how much money the company makes from its core business to its total sales. We can see that back in 2011, the operating margin was about 7.8%. That number grew to about 10.3% in 2015, and ever since then we see a decline in the company's operating margin. For the year 2020, the operating margin was about 4.6%, and for the trailing 12 months it was negative because the operating income was negative. So we can see that the ratio of Macy's core business to its revenue has been declining since 2015. Ideally, we want to see the operating margin to be increasing or staying steady, and that is not the case that we are seeing with Macy's since 2015. After that, looking at the net income. The net income is the bottom line of the income statement. What this number tells us is how much money is left with the company once it has paid for all the costs, expenses, interest on its debt obligations, taxes, and so forth. We can see that back in 2011, Macy's net income was about $847 million. That number grew to about $1.5 billion in 2015, and ever since then, we see the net income fluctuate. For the year 2020, it was about $564 million, and for the trailing 12 months, it was negative. We can see that the revenue, operating income, as well as net income was increasing from 2011 all the way through 2015, and from 2015 all the way to now, the operating income and revenue were declining. However, the net income has been fluctuating. What this tells us is Macy's has been making money below the line. In other words, it is generating money which is not from its core business, which is helping it boost its net income. This means that Macy's could have had a one-time sale, such as it's closing down its stores, it's selling its assets in order to help generate more income so that its bottom line, its net income number can be inflated. Looking at the core business has been declining. However, the net income has been fluctuating over the years. Next, looking at the dividends, we can see that back in 2011, Macy's paid out about 20 cents as dividends, and that number grew to about $1.51 in 2018, and it has stayed at that level since then. For the trailing 12 months, the dividend paid is about $0.76. After that, looking at the payout ratio compares the company's dividend payouts to its net income. So it gives us an idea of how much of the company's money that's left is actually being paid out as dividends. Back in 2011, the payout ratio was about 10.1%, and it grew all the way to 69.5% in 2017. And ever since then, the payout ratio has tapered down. For the year 2020, it was about 48.7%, and for the trailing 12 months, we don't have a meaningful payout ratio because the income was negative. It looks like if Macy's can return back to the profitability and net income that it was making before the pandemic, such dividend payouts can be sustained in the long run. Next, looking at the shares outstanding, we can see that back in 2011, Macy's had about 427 million shares outstanding. That number dropped down to 307 million shares as of 2018, and after that, we do see the share count go up, and it's now at about 311 million shares outstanding. However, when we look at a 10-year period, we can see that Macy's shares outstanding has dropped down from 427 million shares to 311 million shares. What this means is Macy's has been buying back its shares, which increases the existing shareholders' ownership within the company. So such a trend is certainly something that shareholders want to see when investing in a company. Next, looking at the book value per share. The book value is calculated by subtracting the company's total liabilities from the company's total assets. We can see that back in 2011, the book value per share was about $13 per share. And for the year 2020, it was about $19.6 per share. For the trailing 12 months, it was about $7.22 per share. We can clearly see that the book value per share over the trailing 12 months has dropped significantly. This is primarily because of the company taking on more liabilities and writing down some of its assets, which has caused the book value to drop down significantly. And finally, looking at the free cash flow. The free cash flow is what we get when we subtract capital spending from the company's operating cash flow. We can see that back in 2011, the free cash flow was about $1 billion. That number grew to about $1.6 billion in 2015. And ever since then, we can see that the free cash flow has been fluctuating. For the year 2020, it was about $451 million. And for the trailing 12 months, it's about $949 million. So we can see that Macy's free cash flow over the past decade has stayed positive. Ideally, we want to see the free cash flow to stay steady or increase. And over the past few years, Macy's has had fluctuations in its free cash flow. So not something we want to see, but at the same time, the fact that the free cash flows have been positive is a good sign. I will be using the past 10 years of free cash flow numbers for my expected rate of return calculation, and I will be using the trailing 12-month figure of free cash flow of $949 million for my DCF, discounted free cash flow analysis. Next, looking at the profitability of the company, the first item on the list is the net margin. The net margin compares the company's net income to its revenue, so it's a comparison of the company's bottom line to its top line. We can see that over the past 10 years, the net margin has fluctuated in the low to mid single digits. Back in 2011, Macy's net margin was about 3.39%, and for the year 2020, it's about 2.23%. What this means is every $100 that Macy's makes from its sales, by the time it pays for all the expenses, costs, interest, taxes, it has about $2.23 left as pure profit. Ideally, we want to see the net margin to be a big fat positive number, because that way we know and we're assured that the company has the pricing power to mark down some of its goods and still be profitable at the end. Next, looking at the return on equity. The return on equity gives us an idea of the company's net income to its shareholders' equity. Warren Buffett prefers to only invest in companies that have had a return on equity of 8% or greater for the past 10 years. We can see that back in 2011, Macy's return on equity was about 16.56%, and for the year 2020, it's about 8.80%. We can see that over the past 10 years, Macy's return on equity has always been above 8%. Next, looking at the return on invested capital. This number gives us an idea of how good and efficient the management is at allocating the company's capital and getting a return on that investment. We can see that back in 2011, the return on invested capital was about 9.22%, and for the year 2020, it's about 5.60%. Finally, looking at the interest coverage. The interest coverage gives us an idea of the company's interest obligations on its debt to its income. Benjamin Graham, the father of value investing, preferred to only invest in securities that had interest coverage of 5 times or higher. We can see that back in 2011, Macy's interest coverage was about 3.28 times, and for the year 2020, it was about 4.57 times. We can see that Macy's interest coverage over the past 10 years, with the exception of a few years, has stayed more than 5 times. Now let's look at the financial health of the company. The first item on the list is the current ratio. The current ratio compares the company's current assets to its current liabilities. Ideally, we want to invest in companies that at least have a current ratio of 1.0 or higher. And a current ratio more than 1 tells us that the company has enough oxygen in its system to survive for another 12 months. Back in 2011, Macy's current ratio was about 1.36, and for the year 2020, it's about 1.18. We can see that over the past 10 years, the current ratio has always stayed greater than 1. Next, looking at the quick ratio. The quick ratio is similar to the current ratio. However, when calculating the current assets, you disregard the inventory. So the numbers that we see here for the quick ratio disregard the inventory. We can see that Macy's quick ratio back in 2011 was 0.37, and for the year 2020 it was about 0.19. What this means is if Macy's is unable to sell its inventory, it would be gasping for breath in the next 12 months. In other words, the sale of inventory is a big component in Macy's staying liquid. Next, looking at the financial leverage, we can see that back in 2011, Macy's financial leverage was about 3.73, and that number grew to about 4.84 in 2016, and since then it has tapered down. For the year 2020, it was about 3.32. However, for the latest quarter, the financial leverage was about 8.57, which was significantly higher than what we have seen in the past decade. This is primarily because of the pandemic, which caused Macy's to take on a lot more debt. Next, looking at the debt to equity ratio, which compares the company's total debt to its shareholders' equity. Ideally, we want to see this number to be less than 1. Back in 2011, the debt to equity ratio was about 1.26, and over the next 10 years, it stayed fairly consistent. It even dropped down to 0.73 in 2019. Back in 2020, it was about 1.03, and for the latest quarter, it was about 3.62. When we compare the financial leverage and the debt to equity ratio to some of Macy's competitors such as L Brands or Kohl's, we can see that these ratios are comparable to its competitors. Next, looking at the efficiency ratios, the first item on the list is the days sales outstanding. This number gives us an idea of how many days go by from the day Macy's recognizes its sales to the day it actually receives cash for that service rendered. We can see that back in 2011, it took Macy's about 5.47 days. And for the year 2020, it was about 5.83 days. For the trailing 12 months, it was about 3.35 days. Ideally, we want to see the days sales outstanding number to be steady or getting lower, and Macy's is certainly good on that end. Next is the days inventory. This number gives us an idea of how many days does Macy's products sit in the inventory before they are sold. Back in 2011, it took Macy's about 115 days to sell its inventory, and in 2020, it took about 125 days. For the trailing 12 months, it was about 173 days. This jump up in the days inventory over the trailing 12 months is primarily caused due to the pandemic, which has caused Macy's to sell less products, which eventually means there's more buildup of inventory in its system. Ideally, we want the days inventory number to be steady or getting lower because we want the company to sell its inventory so that it can generate profit on those products. Next is the payables period. This number gives an idea of how many days does Macy's take to pay its suppliers. Back in 2011, Macy's took about 46 days to pay its suppliers, and that number grew to about 63 days in 2020. For the trailing 12 months, it was about 176 days. This means that Macy's sits on its cash for 176 days before it actually pays its suppliers for the products. Finally, looking at the inventory turnover, this number gives us an idea of how many times does Macy's inventory go through its system in a calendar year. We can see that back in 2011, the inventory turnover was about 3.16 times, and for the year 2020, it was about 2.90 times. Ideally, we want the inventory turnover number to be as high as possible. That way, we can see that the company is going through its inventory more, which would indicate more sales and more profit. The last thing we want as investors is the company to have its inventory just sit around and not being useful and making money for the company. Now let's look at the current valuations of the company. Over here, we will be comparing Macy's to the S&P 500. The S&P 500 is the aggregate of the top 500 companies in the United States. The first item on the list is the price to earnings ratio. We can see that Macy's does not have a meaningful PE ratio because its earnings were negative. However, S&P 500's PE ratio is 27.2. Macy's 5-year average PE ratio was about 10.6. Next is the price to book ratio. Macy's price to book is about 1.4. The S&P 500 is at 3.8. After that, looking at the price to sales, Macy's is at 0.2, whereas S&P 500 is at 2.7. Next, price to cash flow, Macy's is at 1.9, whereas S&P 500 is at 15.8. And finally, looking at the dividend yield, we can see that Macy's dividend yield is 7.2%, whereas S&P 500 is at 1.7%. So when we compare the current valuation of Macy's to the S&P 500, other than possibly the PE ratio, we can see that on all the other valuation metrics, Macy's is undervalued to the S&P 500. Hey guys, now let's look at the discounted free cash flow DCF analysis for Macy's. I'm using the trailing 12-month figure for my free cash flow, which was $949 million that we got from Morningstar. I'm using the annual growth rate of free cash flow to be 3%. What this means is I'm assuming that Macy's free cash flow will grow at 3% every year for the next 10 years. I'm using a discount rate of 10% And what this means is I expect Macy's to give me a return of 10% on this investment. I'm using the long-term growth rate to be 1%. What this means is I expect Macy's free cash flow to grow at 1% every year from the 10-year mark into perpetuity. Macy's has 311 million shares outstanding, and the long-term debt is at $4,852 million. I got this long-term debt number from Macy's October 2020 10Q quarterly report. After taking all of these inputs into account, we get Macy's intrinsic value to be about $22.65 per share. When we compare this to the current stock price of $10.48 per share, we can see that the current stock price is trading at a discount of about 50%. The way the intrinsic value is calculated is we look at what the free cash flows would be every year for the next 10 years. We sum up all those free cash flows. Then we look at what the free cash flows would be from the 10-year mark into perpetuity. We sum up all those free cash flows and get the intrinsic value to be $11,895 million. After that, we subtract the long-term debt from the number and divide by the shares outstanding to get the intrinsic value to be about $22.65 per share. Now understand that Macy's is one of those stocks which we do not know if it will survive into perpetuity. So if we disregard the perpetuity component and focus on just what Macy's intrinsic value would be for the next 10 years, we can see that it turns out to be about $6.03 per share. In other words, we're just summing up what the free cash flows will be for the next 10 years. We're subtracting the long-term debt and dividing by the shares outstanding to get the intrinsic value without perpetuity to be $6.03 per share. Hey guys, now let's look at the expected rate of return calculation for Macy's. Over here, I pasted the past 10 years of free cash flows that I got from Morningstar. All the numbers here are in millions of US dollars. This is the yearly free cash flow trend that we get. We can see that the free cash flows have been growing all the way through 2015, and then we see the free cash flow has been declining ever since. Looking at the future data and predictions, I'm assuming that there's a 25% likelihood that Macy's free cash flow will grow at 5%. There's a 50% likelihood that its free cash flow will grow at 2%. And there's a 25% likelihood that its free cash flow will decline at 3%. These are the potential free cash flow rates that we get into the future. After taking into account the numbers of shares outstanding, which is 311 million shares, at the current stock price of about $10.50 per share, we can expect to get a return of about 10.6%. What this means is if we were to invest in Macy's at the current stock price of $10.50 per share, we can expect to get a return of about 10.6% on this investment. Hey guys, now let's wrap it all up. We saw that Macy's revenue and operating income had been increasing all the way through 2015, and ever since then, it has been decreasing. Net income followed a similar trend where the net income was increasing all the way through 2015, and ever since then, we see fluctuations in Macy's net income. This goes to show that Macy's is having below-the-line income. In other words, it is selling off some of its non-operational assets to help inflate its net income. After that, we looked at Macy's dividends. We saw that Macy's had been hiking its dividends all the way up through 2018, and such dividend payouts would be sustainable as long as Macy's can return back to its profitability and net income that it had before the pandemic. For the past decade, Macy's return on equity has been greater than 8%, and interest coverage for the most years has been greater than 5 times. After that, we looked at Macy's financial and liquidity measures, where we saw that Macy's current ratio was greater than 1. However, when we focused on the quick ratio, we could see that unless Macy's sells off its inventory, it is not as liquid as it appears to be. Finally, when we looked at the financial leverage and the debt to equity ratio, we saw that for the latest quarter, both those numbers had jumped up because Macy's had to take on more debt in order to stay operational. Next, when we looked at the efficiency ratios, we saw that Macy's has gone a lot less efficient with its inventory. In other words, it was more efficient 10 years ago than it is now. Its inventory turnover is decreasing. In other words, it is going through its inventory less times now than it did 10 years ago. Next, when we compared Macy's valuation to that of S&P 500, we saw that on almost all the metrics, Macy's was undervalued to the S&P 500. Then when we did the discounted free cash flow DCF analysis, we found Macy's intrinsic value to be about $23 per share. And the current stock price of $10.43 per share is currently trading at 46% lower than its intrinsic value. When we disregarded the perpetuity component from our DCF analysis, we found Macy's intrinsic value to be about $6 per share. After that, when we did the expected rate of return calculation, we found that if we were to invest in Macy's at the current stock price of $10.5 per share, we can expect to get a return of about 10.6% on this investment. After reviewing the fundamentals, we can see that Macy's stock price is clearly undervalued. However, this company happens to have an efficiency issue where it is unable to sell its inventory. In the near term, it is likely that the stock price may go higher, primarily because Macy's will try to get rid of its inventory at fire sale, which will help increase its revenue. Moreover, it may be successful at selling off some of its non-operational assets, which will increase its net income. So if Macy's is able to sell off its inventory and sell off some of its non-operational assets, we're likely to see a boost in the stock price. However, if you're a long-term investor, we can see that the operational income, which is the money that's generated from the core business, has been declining, and Macy's appears to lack the moat that would help it set the price for the goods that it sells. In conclusion, if you're thinking about the near term, it is likely that Macy's stock price would appreciate. However, in the long term, this may not be your best bet. Hey guys, that is all I have for you this week. Hopefully you found this video on Macy's interesting. Please do like, share, comment, and subscribe to my channel. And if you have any suggestions as to which stock I should review next, please leave it in the comment section below. I would greatly appreciate it. Thank you.